welcome to The Explainer. Today, we're putting on our equity research hats and stripping away all the market noise. We are acting as a highly disciplined sell-side research team, and we're going to conduct a rigorous valuation autopsy on one of the most talked-about stocks out there right now, SoundHound AI. We're looking purely at the numbers to find the fundamental intrinsic value of this company. Okay, let's just jump right in with our first data point. Look at that explosive 835.85% stock return in 2024. I mean, wow. If you've been following the AI sector at all, you know momentum is a powerful, almost gravitational force. A return like this, it instantly tells us the market is pricing in absolute perfection. Investors are betting on a future where SoundHound completely dominates its niche. But as fundamental analysts, our job is to ask the hard questions. Does the actual financial reality support a meteoric rise like this, or are we staring straight into a speculative bubble? Because, well, then you see this data point, and it's a remarkably stark contrast. While the stock has been literally rocketing to the moon, they are sitting on a deeply negative trailing 12-month net profit margin of minus 198.28%. Think about that for a second. For every single dollar SoundHound brings in the door, they are spending significantly more than that just to keep the lights on and operate. It is a massive profitability gap, and it immediately complicates any traditional valuation attempt we might try to run. So here is our agenda for this valuation autopsy. We're going to cover their explosive financial profile, run through our model filtering sequence, attempt an absolute valuation using a DCF, check relative valuation and multiples, look at their asset-based valuation, and finally, deliver our intrinsic value verdict. Let's get to work. Starting with Section 1, Explosive Financial Profile, or the AI Hype Train. Let's break down the core metrics driving SoundHound's massive $3.98 billion market cap. It really is a picture-perfect example of hyper-growth reality. On one hand, you have massive, near 100% revenue growth, 99.45% to be exact. They are pulling in almost $169 million in trailing revenue with a pretty solid gross profit margin of 43.12%. Top-line expansion is undeniably robust. But that growth is completely offset by a grueling $103.12 million free cash flow burn. The bottom line paints a totally different picture. That negative net income and severe cash bleed tell us this is a business scaling at an immense, painful cost. The real question is, can they outgrow this burn rate? Moving right along to Section 2, Model Filtering Sequence, Selecting Our Tools. Normally, as rigorous sell-side analysts, we want multiple lenses to view a company's worth, right? We look at everything from future cash flows to dividend payouts to asset liquidation. We want to consider all the standard valuation models. But here's the thing. The unique financial structure of a hyper-growth, zero-profit tech firm means a lot of these traditional tools, they're going to break down the second we apply them to the raw data. We actually have to be ruthless here and eliminate several models right out of the gate based strictly on mathematical limitations found in the source documents. Since their dividend CAGR is explicitly 0%, the dividend discount model, completely useless. Throw it out. Next, there's no distinct segment data reported, so a sum of the parts analysis is impossible. Toss that too. And crucially, SoundHound has a debt-to-equity ratio of absolutely 0. That means there are no tax shields to calculate, which makes the adjusted present value model entirely irrelevant. So that brings us to Section 3, Absolute Valuation via the Classic Discounted Cash Flow, or DCF. Now, because the required inputs are entirely missing from the source documents, we have to make an explicit external assumption here. We're going to set a 12% cost of equity to properly account for the extreme risk of the AI sector, alongside a pretty generous 3% terminal growth rate. Without stated default inputs from the company, finding a discount rate is basically an exercise in measuring volatility. And let me tell you, with SoundHound, volatility is through the roof. So we ran the DCF math, and honestly, we hit a dead end. Bridging from $168 million in revenue down to that deeply negative free cash flow results in a fair value price of NA. You literally cannot discount negative cash flows into perpetuity and derive a positive enterprise value. The model just mathematically collapses on itself. And the source data completely backs this up, explicitly listing the fair value price and margin of safety across free cash flow and earnings per share as simply not applicable. Let's pivot. Section 4, Relative Valuation and Multiples. The pure check. Brace yourselves, because looking closely at these metrics reveals some serious absurdity. An enterprise value to EBITDA ratio of almost 344, that is astronomically disconnected from anything resembling traditional value. We're looking at a trailing PE of negative 187 and a forward PE sitting at an eye-watering 227.27. What this tells us loud and clear is that investors are paying purely for future potential. They are completely ignoring current operational reality. Since no comparable peers are identified in the filings, we have to assume standard tech benchmarks here, and that dictates that SoundHound's EV to sales of 22.11 demands absolutely flawless future execution. Just to put that into perspective for you, an EV to sales ratio over 20 means you are paying over $20 for every single dollar of gross revenue, regardless of whether that dollar generates even a penny of profit. In the software industry, an evaluation like this implies an expectation of continued near 100% top-line growth for years and years to come. Okay, Section 5, Asset-Based Valuation, Finding the Liquidation Floor. Finally, we actually find a rare bright spot. They have a fortress of a balance sheet with zero debt and a highly liquid current ratio of 4.59. Having a quick ratio matching that at 4.59 means SoundHound has immense short-term liquidity. They're absolutely not going bankrupt tomorrow. Their lack of debt gives them this vital runway to keep funding their operations without the immediate pressure of creditors knocking at the door. But there is always a catch. Trading at over 5.43 times enterprise value to assets means the stock price far, far outpaces any reasonable net asset value or liquidation floor. Look, if the business model fails, there's virtually no physical or liquid asset base to protect shareholders at a nearly $4 billion valuation. You're paying a massive premium for the intangible, theoretical value of their AI technology, not for hard assets. Bringing it all together now, Section 6, the final intrinsic value verdict. Based on our objective analysis across EPS, free cash flow, and calculated margins of safety, the fundamental intrinsic fair value price is unequivocally NA. The extreme negative margins, the $103 million cash burn, and a return on invested capital sitting at a negative 5.80% make it mathematically impossible to assign a traditional intrinsic value to this equity. It literally defies fundamental gravity. So we'll leave you with this final thought to wrap up today's explainer. You've seen the unbelievable hypergrowth on the top line, but also the immense cash bleed on the bottom line. You've seen the fortress balance sheet contrasted with multiples that honestly border on science fiction. So based on the fundamental numbers presented today, where do you stand? At a nearly $4 billion valuation with over $100 million in negative cash flow, are you buying a fundamentally sound business? Or did you just buy a super expensive ticket on the AI hype train?